Okay, accounting students, I am going to run through our first lesson, our first flipped classroom lesson. This is the textbook, principlesofaccounting.com, and I'm in the first chapter. And I'm going to go to the first section of this chapter and talk a little bit about accounting information. We covered this in class today. I want to go a bit more into detail. So these were the definitions that we had in class. And one of them I want to really highlight, so as you're going through the textbook, right, you can be highlighting these things or making your notes, is that these are the concrete definitions we're going to use in this class, right? Accounting is a set of concepts and techniques that are used to measure or report financial information about an economic unit, okay, right? A separate enterprise of business, in this case, a restaurant. And it's used to report a variety of pieces of information to a variety of different parties, right? We talked about this in class. And we need this information for these reasons. Again, this is all in our slides on what we learned today. There are two types of accounting, right? Financial accounting is used to record information for things that have already happened in order to look forward. Whereas managerial accounting is looking at internal information relating to costing and decision making in that way. So there are two different types of accounting. We are focusing on financial accounting in this class. Another thing I want to point out here is there's some information in the textbook about different accounting standards boards. We're not overly concerned with them because this is a very introductory class. But if you want to know what standards board we are looking at the International Financial Reporting Standards. And there are many all over the world, depending on what country you come from. That country has different financial standards because accounting is a language. And everywhere we go, right, we have different languages that people speak. It's just the same as accounting. But in the last few years, we've been trying to standardize our global accounting language. And that's what IFRS is. Okay. The other thing I want to point out about accounting information is what's in this paragraph here. Accounting data are not absolute or concrete, right? We're talking about the limitations of accounting data in class today. We can only really measure things that have a cost, right? How do we measure the feeling someone has when they come into our restaurant? Well, we really can't, right? But we can measure, how much our interior decorating cost, right? And really, we're looking at things based on historical cost. So we can't say, oh, I paid $100 for this building, right? Very cheap building, but it's worth $1 million to me. So I'm going to write it down at $1 million. We always have to be concerned with how much we actually spent on something. And that's a very important distinction as well, especially in this course. So the next section of the textbook in chapter 1 is on ethics and careers. And I'm going to skip over this section, but I think that it's very, very interesting if this is something that you're interested in pursuing. So you can read a little bit more about that and move towards the accounting equation, which is our forward-looking lesson for today. This right here, this accounting equation, is the most important thing you will learn in this course, right? Assets equals liabilities plus owner's equity. A equals L plus OE. So assets, this is an important definition. You should be writing this down. Assets are the economic resources. That means something we own that can make us money, right? Cash can make you more money. Accounts receivable, which is money that other people owe us, right? Inventory, we make money off of inventory, land, buildings, equipment, right? These are things that we own, our business owns, that make us money. Those are assets. Liabilities. Liabilities are things that we owe to other people, loans, credit, other obligations. So assets are things that we own. Liabilities are things that we owe. When you get left over, right, we were looking at it today, you have what you own, you have what you owe, but then there's this other, piece in there is your stake in it all. And so owner's equity is the owner's stake in a business, right? Not, you don't owe this to anyone else. It's what you have put into your business, right? And that can sometimes take the form of cash, which shows up on the other side, or equipment, or other forms of investment. Okay. And this is an example of a professional balance sheet as opposed to a personal one. So we've listed all these assets, and you can look around on here. And then we have what this person owes. They owe accounts payable to other businesses. They have a loan right? And then they have some stock. We're not going to talk much about stock in this class, but you can see that this business, Edelweiss Corporation, has a good portion of their balance sheet comes from their equity, and they have a good land and building and equipment. We don't actually know what kind of business this is based on this, but we can see where they make their money. All right. So let's get forward here. And then from here, I'm going to post another video that explains the effect of transactions on the balance sheet. So this is me sort of a prelude to that.